Hi everyone, my name is Dennis Maynard. I am a real estate broker here in Los Angeles. Some of you know me, some of you don't. That's fine. What we're going to talk about today is very important. We're going to talk about the subject of inflation. And by the end of this video, you're going to know the various types of inflation, including deflation, and you're also going to know what causes it and what to do about it. Because we're in a situation right now where we could potentially see strong inflation into the future. Now, what does that mean? Inflation isn't always bad. Sometimes it can be good, but we're going to answer these questions right away. So stick around and we'll get going. All right, to start off, we're just going to take a look at some basic definitions. And the first one we're going to look at is inflation. Now, inflation is the overall rise in the level of prices. Now, how do economists measure this? Well, they use various tools to measure levels of prices over time. In the United States, we use the Consumer Price Index. Another tool that they will use is also called the GDP deflator. Now, you can measure overall level of prices change with any particular index, but these are the two primary indexes that they use. So every world economy experiences inflation or deflation on some level. We're going to get into deflation in a minute. But right now, just know that it means that it's an overall rise in the level of prices. Now, you would experience this if you've been shopping or gone to the gas pump lately. There has been an increase in the overall level of prices overall. But one particular type of inflation was called stagflation. It was identified in the 1970s. This happened when we had a period of falling output and rising prices. So that meant we were producing less, but prices were still rising. Now, it also is relative to the amount, how high the unemployment is. So if there's relatively high unemployment as well, this is the circumstance that creates stagflation. So remember, inflation is still the overall level rise in prices, and that stagflation is just this particular circumstance in which we see falling output along with relatively high unemployment. This was triggered in the 1970s by high oil prices. This had a lot to do with the OPEC and what was going on at that time as they were trying to reduce production and increase prices on crude oil. It did have a massive impact. You can see right here on the right-hand side, the real WTI or West Texas Intermediate crude prices and versus the nominal WTI or nominal West Texas Intermediate. The point is, you can see that the price spike was pretty substantial overall. And these high prices led to stagflation. The next type of inflation that we're going to talk about that we need to be aware of is called hyperinflation. Now, hyperinflation, it can be misused here and there, but it generally means that inflation is exceeding 50% per month. Now, some of you are going, that seems crazy. Well, it is crazy. Basically, what causes it generally is printing of money. And this was true, as an example, of Germany following World War I, in which they were required to pay damages to all the various countries per the Treaty of Versailles. And this led to German government at that time printing money and hyperinflation. In fact, it hit 30,000 per month at one point. Now, this is not the most extreme example, but it's probably the most widely known. One would argue that this hyperinflation led to the demise of Germany and ultimately led them to the rise of the people that we didn't want in power in World War II. As you can see in the photo, there are note gold banknotes. These are awaiting distribution. This was during this hyperinflation period in Germany. Now, We're going to go over a couple more hyperinflation examples because I want to really drive this point home. Let's take a look at Zimbabwe. Zimbabwe from 2007 to 2009, as a result of political changes that were focusing on the redistribution of agricultural land or redistribution of wealth, that led all the wealthy people to flee the country. They basically took their money and said, I'm out of here. I'm not dealing with this. You're going to steal my land? Fine, I'm out. Well, this led the leaders of that country to start printing money. And in fact, at one point, it was 489 billion% in 1 month. That's September of 2008. 489 billion% in 1 month. That's how bad hyperinflation can take hold. Now, on the chart on the right, you can see Zimbabwe's inflation rate. As of recent, they had another really bad problem with it in January 2019 through July 2019, in which they reached 350% in 1 month. Why? Because they're printing money. It just doesn't work. All right, let's talk about Hungary and the end of World War II. Same thing. Reparations payments. Inflation rate reached at one point 41.9 quadrillion% in 1 month. That means they were printing so much money that they had that level of inflation. That means prices doubled every 15 hours. Let's continue. Venezuela, table's not shown, but the Venezuelan government has printed money and has led to their demise. Yugoslavia, same thing. They also had problems with hyperinflation. So these often led from political changes and that were including various government programs in which they had to fund spending that they couldn't afford to come up with the money or tax people on. They just didn't have the money to tax them. So let's continue. Deflation. Deflation is the decrease in the overall level of prices. It's measured on CPI, GDP deflator, or any other index. Now, the Great Depression was a deflationary period. The Great Recession was a deflationary period temporarily. But the reason why the Great Depression was called the Depression was because it lasted a substantially long period of time, from 1929 really until about halfway through 1932 into 1933, in which they actually got things to start growing again. But you can see here on the chart to the right that the example with a low of negative 8.4% inflation rate in 1932. Now, inflation as a tax. Now, this is a concept from economics. This is basically saying the same thing that I've said in just a moment ago, that when tax revenue is inadequate and the ability to borrow is limited, the government may print money for its spending. Now, see, in a fiat system, instead of a gold standard, you can print money and it's based on the goodwill and faith of the taxpayer to pay and its ability to grow. There's a hidden tax in there, and we call it the inflation tax. And this is when it's not worth it to hold dollars. In other words, just by holding a dollar, it becomes worth less because they're printing money and it causes the value of that dollar to decrease. This is technically a tax. It happens in more than one ways than one, but it takes more dollars to buy goods and services. This is usually how hyperinflation takes hold. Now, I'll be brief here and just say, do I think hyperinflation is a potential problem here in the U.S.? No, not right now. Do I think it could happen? It can happen anywhere. So it really depends on how the governments of the world decide to run their individual economy and the people as to whether or not they will tolerate it. That's really what it comes down to. So, but right now, we are in a situation in which we are seeing rises in prices. And we're going to get into why and what's happening and whether the timing of what's happening is impactful with what we don't really want. which is substantially higher prices. Hyperinflation? No. Substantially higher prices? We're already seeing it, and it could continue. So let's talk about it. Economic principle number 9. Now, this is straight out of my economics books. I took macro, microeconomics, and I've had economics and studied it over the years. It's just as a part of understanding monetary policy when I learned about trading currencies. Prices rise when the government prints too much money. So when does the market decide when the government has printed too much money? Well, over time, there's various metrics that have been used to monitor how much money supply and money demand is out in the marketplace. But ultimately, this is what creates value of money, aka price level. So it's when how much money supply is out there, how much demand for money is out there, and at the intersection of the two, it creates an equilibrium point in which value is created. Price and quantity intersect. Now, some of you may not have seen one of these. This is what it looks like when economists look at the various curves. They are generally multiple intersections of data on a graph. This particular graph is demonstrating the quantity theory of money. This is based on the quantity of money available determines the price level, and that the growth rate in the quantity of money available determines the inflation rate. Let me say this another way. It's more dollars to buy the same thing, and dollars become worth less. This was advocated by Milton Friedman. Allow me to demonstrate on the chart here just briefly. So here we have, if you look at MS1, MS stands for money supply. And MS2 represents a new value of money supply, 1 being $1,000 and 2 being $2,000. On the y-axis, we have the value of the money. On the x-axis, we have the quantity of money. So if we have at intersection point A, as you can see on the graph, that the value of money is 1/2 of P, or price, and we add more dollars to the system, meaning we're going from $1,000 to $2,000, or we're printing money to create more money, then the value of that money declines. It actually becomes worth less. So we have a new price point of equilibrium in which the value of money is worth less. Now, I hope that's a simple example of how this theory works, but it generally holds true. So this is one of my favorite cartoons right here. It demonstrates how you can have a robust economy, and then if you try to create inflation, it's just a bunch of hot air going into a balloon, and you lose your economy in the process. There's another theory that's out there with economics, the balance between inflation and unemployment. We're not going to get into that. But what we want to talk about briefly is what is the current inflation rate and how does it affect me? That's really what we're talking about here. What is it now? What could it be? And how will it affect me? Well, the effects of inflation are that real estate prices will rise, cost of borrowing will increase, lenders will eventually raise rates, or the government will, in order to try and curb off massive inflation. It happens in hyperinflation too, but even massive inflation, when you're seeing too much price growth in the market, that you have the potential for consumers to stop spending and businesses to stop spending and investing, that it causes a problem and it creates a pullback in the economy. This is the balancing act that the Fed and the economists try to balance between the two. Real estate and rental rates will soar. Rental properties are considered a hedge against inflation. Now, we're going to talk about this briefly in a minute. Prices rise. I think we've already seen that, and I'm going to demonstrate that further in a moment. Increased taxation through nominal wage growth versus real wage growth. What does that mean? So you might get paid more hourly, but you're also being taxed more through increased taxation, as well as your money's worth less. So it takes more dollars to purchase more. So they're actually driving you into taxation. This is the inflation tax demonstrated again. Daily needs of goods and service prices rise as well. Yeah. So we've already seen that. Food prices, gas prices, they've been rising, and it's a tax. Let's talk about that some more. So here's the price rise in May of 2021. Now this is a 12-month percent change. Most people who are feeling this haven't actually seen this on a graph because they don't really present it in this format. This is directly from the BLS, or Bureau of Labor Statistics. They track this data because they tracked pricing changes. And as we can see, all items overall in May of 2021 rose 5%, energy rose 28.5%, gasoline rose 56.2%, natural gas rose 13.5%, and food rose 2.2%. Now, all of those items impact you on a daily basis. There's no stopping it, there's no getting around it, because you need these things in order to survive. These are daily goods. And the services that provide them also increase their prices so that they can compensate for the increased cost to them as well. Well, let's talk about briefly the hidden tax of fuel prices. So we've talked a little bit about the inflation tax portion of it, meaning that the fact that prices rise is a tax on you automatically. What most people don't realize is how much taxes are actually in fuel prices. So we're going to talk about California specifically, since we're here in California. Californians pay approximately $1.20 in every gallon of fuel that they pump into their car in taxes. Now, for all those green energy people, guess what? If they can't collect it in the gasoline, they're going to collect it somewhere else. So just be aware, this isn't over. But for right now, this is what it costs. And these prices and these taxes go into your food, your services, how much people charge you, how much businesses charge you for goods and services, as well as the costs overall. This can be a fuel, for lack of a better word, for more inflation, as we saw in the 1970s. And it can lead to a stagflation, which is a reduction in output, higher unemployment, with an overall rise in prices. I hope that makes sense. Let's keep that in mind. But overall, the cost that it's costing everybody, when we look at the Fed excise tax, that's 18.4 cents. That's on everybody's gasoline. We have the California excise tax, which is 37.8 cents per gallon. We have the California sales tax, which is 10.7 cents per gallon. And then we have the ever so popular and increasing tax of California SB1, or also known as the gas tax, at 12.7 cents per gallon. There are additional various bonds and requirement measures that are for storage tanks and fuels under the cap fees for capping unused storage tanks. Those are effectively 14.3% and another 2 cents for the underground storage tanks fee. Now, on top of that, we also have our low carbon fuel standard tax. This is basically a carbon credit exchange tax, if you will, at 22.6%. 22.6 cents per gallon. Now, this is a tax on real incomes. Why is it a tax on real incomes? Because it's an immediate calculus onto your daily incomes. And if people are on fixed incomes or who have lower incomes, it impacts them more than it does the wealthy. That's why the wealthy keep on voting these things in California, because they think that everyone can absorb it. Well, no, they can't. I appreciate where your head's at, but no. Now, what else rises during inflation? Well, home prices. Home prices have risen rather dramatically. Now, this isn't necessarily inflationary per se, but it's becoming inflationary. And let me explain why. Home prices have been rising because we've seen a major shift in demand over the past year for single-family houses. We also saw extremely low supply, meaning people didn't want to give them up. And then on top of that, the builders who were not building enough houses over the past 10 years now got caught with their pants down and they didn't have enough supply to deliver. What ended up happening? Well, Materials prices increased, including lumber and copper, which is a major component of home building and construction. That rose because of lack of supply, increased fuel demands, increased transportation costs, and mills being offline. Will these prices persist? Well, we don't know. What we do know, though, is that if fuel prices continue to persist at an extra high level, it will put enough pressure on the economy and the spending of the consumer, as well as material prices, that they will maintain a higher level over time. And that could lead to potentially stagflation and higher prices even further. But for right now, this is really a supply and demand issue. Are you going to have the same issue with condos? Not really right now. Actually, generally, it's mostly falling in the single family category that we're seeing this increased pressure in pricing. What are the current prices for home? Well, the appreciation over the past year over year for Q1 of 2021, I mean, as you can see on this map, overall across the United States has been 12.6%, with the highest being in the mountain time zone at 15.7%. That's pretty substantial. That's much more substantial than economists were predicting even a year ago. Will it persist? Don't know. But I would say if fuel prices continue to put pressure on the economy, yes, we may see consistent increase in pricings even over this year. But I don't think that that's the major contributor. Let's talk about that. So we're going to take a quick look at inflation, but we're going to take a different type of look at this. What I've done is I've downloaded the data and I've used some of my trading techniques in order to track data over time. And I've created moving averages for 12 months, 2 years, and 5 years rate of change of inflation. So many people are saying, oh, this is transitory. Well, let me ask you a question. If it's transitory, would prices be higher than what they were in 2019? Would the CPI be higher than it was in 2019? Or would it be merely gauging the depths and lows of the recession, which is what they're trying to imply by transitory? Let's take a look. As you can see on this slide, you can see that there are 3 lines. There is the bottom being the 12-month average, the 2-year average being in the middle, and the 5-year average being on top. This is going all the way back to the 1950s, so we're going to blow it up just for the past few years from 2000 until 2020 and into 2021, which is, it's in there, it's just not showing the date on there. So just know that 2021 is in there. Let's take a look at this. So, have prices risen on the 12-month? Yes, they've risen 3% over what they were in May of 2021. Have they risen over 2019? Yes. Prices have risen 4.8% over what they were in 2019. This is May's numbers, by the way, so these are current. June numbers come out middle of July. Last but not least, what is our 5-year average? Our 5-year average of prices is 12.2%. That means that prices are 12.2% higher than what they were 5 years ago in 2016. Now, part of that is due to growth, but as you can see, the growth was pretty consistent, holding for quite a while at 6.7, 6.8, 7.8, 8.0, and 9.2, and only recently spiked. In fact, the most recent spike of 12.2 is happening just in the past year. Now, we did have to reinflate the economy with everything that was happening and what was going on, but did we overstep our bounds? That is the question. And could we continue to overstep our bounds? Yes, we could. So let's take a closer look at this. What actually caused this? Because remember, economic principle number 9 is prices rise when the government prints too much money. But when is it necessary and when is it not? Right here we can take a look. This is the inflation rate by month and the money supply. Now, As you can see in 2020, basically May of 2020, the inflation rate fell almost to zero, if not close to negative. And it needed a boost in order, because we basically shut down our economy. We needed to stimulate it. This was very similar to the Great Recession, in which they needed to stimulate the economy. The difference between then and now is the Great Recession was systemic problems in the system. Now was we shut down for a pandemic. The world did. So the entire globe shut down. In fact, I remember that day. It was March 15th. So looking at this, you can see that when they started to stimulate the economy, they started to pan it out a little bit and thinking that they had enough in there and that it wasn't quite enough. Due to extended shutdowns in certain parts of the country, they determined that they needed to put more stimulus in the economy and continue to stimulate businesses. They did it the right way. They pumped money into the businesses and kept their employees hired and facilitated changes that need to happen in order to keep things going. And this kept businesses alive. They also did it some of the wrong ways. They kept, pumping it out into various programs, unemployment and whatnot. While necessary, may or may not have needed to extend it on that. I'm not going to get into that. Let's just know that they did it. That's all we need to know. So we saw an increase in the overall size of the money supply. Okay, so on this slide we can see inflation and money supply from this past year. Now, the question that we're asking is, did we overstimulate the economy? Did we create too much money supply in which we're seeing prices rise? My argument is yes, but when did it happen? It actually happened and started happening in February of 2021. You can see the jump up in inflation as the economy started to open, but they just kept on spending at an accelerated clip. And when I say they, I mean the government and Congress, and with all the different programs that they were trying to pump out. They didn't need it. In fact, it was arguably not worth what they were trying to do. I'll explain further. Here we can see the GDP, the gross domestic product, versus the money supply. Now, last year, if you look at underneath the money supply, they increased money supply by 4.7%. Was it warranted? Yes, because if you look at the gross domestic product on the left-hand side, we had a complete shutdown. Prices, everything stopped. It dropped like a rock. We had to do something to make sure that it would recover, or give you the V-shaped recovery, which you're seeing on the chart. Now, did it recover? It did. And it recovered by the end of 2020. There was no need for additional stimulus at this time. But in this first 5 months of this year, the government has printed 5% more money than than it was in January. So what does that mean? They added to the money supply by 5%. If we go back and we look at our money supply one last time for the past 2 years, you can see it's a very steady growth accommodating demand. And then we spiked it, but then they are spiking the ball right now. So why is this important? Well, because of the amount of spending they're talking about doing this year. The current administration is talking about spending another $6 trillion this year. They've already blown the budget, and they're going to blow it some more. In fact, one would almost say blow it up. It is crazy how much money they're spending. They need to curb it so that the economy can catch up, unfortunately. But they're not going to. They're going to continue to push ahead. So how do you respond in this type of an inflationary environment? Because inflation is here. It's going to continue growing, and we could see some inflationary pressures, such as the 1970s, come into play fairly quick. What do you do? Well, fortunately, there are a couple things that you can do. There are basic hedges against inflation that will protect you. We're not going to worry about what comes after inflation. Right now, we're just going to worry about inflation itself. We'll deal with what comes after later. Inflation, as we said, is the overall rise in the level of prices. So that means that any kind of asset that you can be in as an investment, including your own home, is valuable. it will rise in value over time. So this includes real estate and rental properties, gold and silver, commodities, stocks, tips, or treasury inflation protected security, and REITs. Now, REIT is a real estate investment trust. I have a link above to a video that you can go watch on REITs and different types of investments in using REITs. But these are the primary hedges against inflation. Note that people typically look at real estate, gold, silver, stocks, and commodities the most. They use tips or REITs as modifiers, really, when they cannot afford to be in other things. So how is real estate a hedge against inflation? Well, the property values increase. Borrowing costs will eventually be higher, so you're fixing your borrowed cost over time, which gives you an advantage over time. And then rental properties can adjust quickly their rents against the market. And guess what, guys? Rental rates, if you're a renter, it's going to soar. This is the rental rates increase over time since 1994 on the right-hand side. Seem crazy? It could go worse. So it's important, if you can, to find some kind of an asset to get into to fix your housing costs, if you can. And then if you're in a place where you can actually invest into real estate income properties, then there are different ways to do that. We're going to get into that in a second. Interested in learning more? Well, here's what you do. There's multiple things that you can invest in over time. And I'm happy to discuss this with you at any time that you want in a private consultation. But for starters, home ownership. Individual ownership of real estate, owning your own property, fixing your housing payment over time is a great way and hedge against inflation. It's important. You're going to get the benefit of the price rise. You're going to get the benefit of all the other avoidance of rental increases over time. Speaking of rental increases, that also means that multifamily properties are a great investment during an inflationary period. Why? Because rents continue to rise, the income continues to grow, and if you own it on a fixed mortgage, then the amount that property costs you every single month stays fixed, while the values and the rents go up. Hedge against inflation. There are other ways to own income properties. If you are more interested in not direct management and you want hands-off ownership and you only want to attribute this to a portion of your portfolio, there is something called group investment. That is for people who are accredited or qualified investors according to the SEC. There is a link below in the description of this that will get you to a form that which you can fill out. It's a few questions and it will get you in touch with me and we can discuss your situation if you find that this type of an investment is important for you. Not all people will qualify for this, be aware. However, there is another type of investing which is called REITs and crowdfunding. These kind of fall into the same category now, but not so much. REITs can be found not only on the stock exchange, but there's also private REITs. I do not recommend investing in private REITs unless you've done your homework, with one caveat. There was crowdfunding that came about during the past decade, and groups that started out as crowdfunding sources, meaning multiple investors for less, funding into real estate investment, they transition into a REIT format, which is a private REIT format, not traded on the stock exchange. These are not, they still follow under the requirements of the SEC, so they have guidelines and regulations that they have to adhere to. One of them in particular, who I've mentioned before in the past, two people, is Fundrise. Fundrise is a crowdfunding platform that transitioned into a REIT format for reporting purposes and ease of getting capital in and out of deals. That said, there are other types of real estate investments as well during an inflationary period. I will say that not all types of commercial real estate are good in an inflationary environment. Please reach out if you have questions about that. I'm happy to answer that question. Here is my contact information. Again, you can find the link to the form below in the description of this video. And if you are wanting more reading, there's a few books that I do recommend. Obviously, Milton Friedman, Adam Smith, The Wealth of Nations, which was actually written at the beginning and the birth of this nation, and was one of the frameworks which our founders established the system of government and capitalism that we have. It's an absolute outstanding reference book for where we're at and where we came from. The Federalist Papers, yes, this is describing and arguing for the federal government that we have, but it also argues for capitalism and the system that we have as well. There are a few other books on here. Some of them are textbooks, some of them are great books. Please check them out. So, rounding this all up, where did we come from and where do we get to? Well, we started with trying to get some basic understanding, which we did, of inflation, stagflation, and deflation. Then we moved through the process a little bit more, and we talked about what are the causes of these various types of inflation. We got into that. We reviewed economic principle number 9, which is that prices rise when governments print too much money. And then we covered where we're at and what to do about it. Again, if you have any questions with what's going on currently in the economy, please feel free to reach out. Subscribe to the channel because I do cover this stuff on a regular basis, as well as if you're interested in protecting yourself against inflation, reach out as well. I have solutions to help you with. Thank you so much. I appreciate you listening to this video and look forward to speaking to you on the next TNT.